We should take advantage of Warren Buffett while we can, because I don't think we'll ever see another investor like him. At least for me, he is the best investor I've ever seen. He can explain things, pick stocks, and makes money in difficult market situations. We are fortunate that he is still with us in 2023 so that we may benefit from his knowledge, gained from his extensive market experience. We'll go through 9 investment pointers in this video on how to invest like Warren Buffett in 2023. We must first comprehend what the heck happened in 2022 in order to know what to do in 2023. Many investors had to discover the hard way that equities do not just increase in value over time. Over the years, Warren Buffett has helped us understand the main factors that influence stock price movement. Interest rates are the main driving force. Interest rates are to asset prices what gravity is to Apple, according to a famous quote from Warren Buffett. There is virtually little gravitational force on asset prices when interest rates are low. It follows that the gravitational attraction is strong when interest rates are high. In the same way that the apple falls when gravity is strong, the stock market also falls when interest rates are high. Jerome Powell, the chairman of the Federal Reserve, has been raising interest rates, which have increased from practically 0% at the beginning of 2022 to 4.33% by the end of 2022. This is not a little rate increase. The stock prices have fallen as a result of this, in accordance with Buffett's approach, due to increased gravitational attraction on the market. Powell intends to continue rising rates in 2023 because of this, which is a major factor in the decline in prices. We need to be ready for the possibility that this will keep driving stock prices down. Thankfully, Buffett has been able to teach us throughout the years how to handle dropping stock prices.
Well, I look at a lot of figures just in connection with our businesses. I like to get numbers, so I'm getting reports in weekly in some businesses. But that doesn't tell me what the economy is going to do 6 months from now or 3 months from now. It tells me what's going on now with our businesses, and it really doesn't make any difference in what I do today in terms of buying stocks or buying businesses. What those numbers tell me, they're interesting, but they're not guides to me. If we buy a business, we're going to hold it forever. So we're going to have good years, bad years, in between years, maybe a disastrous year some year, and we care a lot about the price. We do not care about the next 12 months.
By studying the stocks that Buffett purchased in 2022, we can gain insight about how to buy in 2023. Most recently, it gives us an understanding of what he's seeking in these kinds of market circumstances. Buffett did buy a good number of stocks last year, although some of them were only worth 1% of the portfolio overall. As a result, there were 3 significant purchases that Buffett made.
First day I bought stocks was March 12th, 1941, 42. And the stocks were down about 2% that day, as it turned out. Unfortunately, I bought in the morning, so when I came home in the evening, and my dad told me the execution price, it was down 2%. If you're buying a business, and that's what stocks are, businesses. In fact, people will be better off if they say, I bought a business today, not a stock today, because that gives you a different perspective on it. Then presumably, if you buy a farm, if you buy an apartment house, if you buy a business, you're going to own it for 10 or 20 or 30 years. And the real question is has the 10-year or 20-year outlook for American businesses changed in the last 24 hours or 48 hours? And you'll notice many of the businesses we own, partially own. American Express, we've owned it for 20 years. Coca-Cola, we've owned it for 40 years. Those are businesses. And you don't buy or sell your business based on today's headlines. And if it gives you a chance to buy something that you like and you can buy it even cheaper, then it's your good luck, basically.
He prefers to invest only in things that he fully comprehends. It's fair to say that the current economic climate is challenging. The good news is that the bad enterprises are being forced out of business, but the bad news is that the economy is now struggling. The only time you can find out who has been swimming naked, according to Warren Buffett, is when the tide goes out. It's a good thing since society needs these companies to shut down. Bad companies are not necessary. Whoever chooses to invest in these terrible enterprises, however, would also suffer from this. In light of this, It will be especially crucial in 2023 to support companies that produce high-quality goods that are actually demanded by the public. These companies are exceedingly improbable to be swimming nude and extremely improbable to be exposed during challenging economic times like recessions. Buffett has been investing in high-quality companies over the years, including Coca-Cola, Applecraft, Heinz, and Duracell.
We're gaining share around the world, so those are the kind of businesses I like. I like wonderful brands. You got to take care of them, but if you take care of a great brand, you know, it's forever. And those are the businesses I like. We own 400 million shares of Coca-Cola stock, as you know. We've never sold a share, and I wouldn't think of selling a share. I think, well, in my lifetime, since 1930, real GDP per capita in the United States has gone up 6 for 1. Think of that, 6 for 1 in one person's lifetime. We have not lost the secret sauce, so that's the kind of future I see ahead too. And if that's the future, you want to own businesses that are going to participate in that future. And we've done that for decades now at Berkshire Hathaway, and we'll continue to do it.
In order to warn investors about companies with excessive debt, Warren Buffett has used the analogy of a horse that lags when it comes to company acquisitions. In bull markets, too much debt performs well, but in bear markets, it is exposed. It is like a horse that occasionally limps.
I get letters every day from people who have problems in life, and it's been very easy for them to borrow money, and they're in over their heads, and it's all over then. I constantly give advice to young people, and just don't start out behind the 8 ball. I mean, it's crazy to get in debt because it's so hard to get out of debt. And the idea of trying to borrow money at 18% and thinking you're going to get ahead in life, it isn't going to work. I urge people to use their credit card, but I urge them to pay it off before it starts revolving, because once you get in it, it is hell to get out.
How applicable is it to the realm of investment when they say that a fool is one who understands the cost of everything and the worth of nothing? Stupid people check the price at which stocks are selling to see if it increased or decreased by 1 percentage point every day. However, those that invest in accordance with Warren Buffett are more focused on value than price. Investing gets significantly simpler if you are aware of a stock's genuine value. Buying the stock with a price significantly below its genuine value is the result of simply examining all of your investment options.
You may have trouble believing this, but Charlie and I never have an opinion about the market because it wouldn't be any good and it might interfere with the opinions we have that are good. If we're right about a business, if we think a business is attractive, it would be very foolish for us to not take action on that because we thought something about what the market was going to do or anything of that sort, because we just don't know. And to give up something that you do know and that is profitable for something that you don't know and won't know because of that, it doesn't make any sense to us, and it doesn't really make any difference to us.
There's nothing magic. We like to put a lot of money in things that we feel strongly about, and that gets back to the diversification question. We think diversification, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. It's conventional practice, and if all you have to achieve is average, it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own 1 stock, but it's a business I know, and it leaves me very comfortable. Do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. 3 wonderful businesses. It's more than you need in this life to do very well. The average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business.
When it comes to investing, it's definitely a good thing to think independently if you find that you frequently disagree with the herd.
I only get into situations where I do know the value. There's thousands of companies whose value I don't know, but I know the ones that I know, and incidentally, it isn't. You don't pinpoint things. I mean, if somebody walks in this door now and they weigh between 300 and 350 pounds, I don't need to say they weigh 327 to say that they're fat. Right. So if they're in that zone, you know, I'm fine with it. And but I also know that there's all kinds of companies that I can't figure out. So I don't. So I do know. I usually know when I'm dealing with companies that I understand, and then I do. Accounting is a language, and it's a language that I like.
What asset class should I invest in, is one query you might have for 2023.
You have to buy businesses, or little pieces of businesses called stocks, and you have to buy them at attractive prices, and you have to buy them, and you have to buy into good businesses. And that advice will be the same 100 years from now in terms of investing. That's what it's all about.
I believe that stocks, sometimes known as enterprises, are the best option. I will add one small warning: if you're older, you might want to think about investing in a less volatile asset class because stocks can occasionally go through periods of decent profitability. But as history has shown and as Warren Buffett has demonstrated, stocks are the way to go if you're young or middle-aged. We appreciate your interest in watching this video. Awaiting for your next view in our upcoming video.